Everybody, welcome to Weka. Not 100, it's 204. So, bajillion, but it's 204. So, Jack is at some kind of conference, boondoggle, but I'm sure it's a conference. And I think it's out west somewhere. So, anyway, he said, hey, I looked at the schedule and I'm not going to be able to join you. So we said, okay, this is a perfect time to go deeper into, the Tax Cut and Jobs Act, set to sunset and expire. What's that going to mean? As well as crazy budget trial balloons that are getting floated out of Washington, D.C. from people that are completely out of touch with the working man, even though they say that they are, they're not. So anyway, what does all that mean for you as business owners and us, quite frankly? What does that mean? So fortunately, Adam Boatsman is going to demystify all of this for us. So Adam, the floor is yours. Anybody that's got questions questions, hit me up with the Q&A. You can harass us on the chat, and I can see you better because my gas bubble is dissipating rapidly, and I'm so grateful for that. So anyway, Adam, floor is yours.
Yeah, I got you. So thank you, Gary. I'm going to do some presentation that anybody's happy to hop in and ask a question as they have it. But just, going back to like basic data. And I didn't pull a jack and print up some graphs, but we did get one graph forwarded to us from Randall Allen in terms of like how much more the national debt is costing us in terms of payments that are having to be made than it has in years past. And this is just, because you hear so much on the news, and it's not that it's misinformation. However, it is like okay, well, like, but what have we always done? How's that compare to what we've always done? Which is a little kind of bleeds a little bit into how this tax thing is going to go. But with respect to the debt, it's just a reminder for everybody on the call that, that the debt is incurred when, really in two circumstances. Number one is I borrow money to pay for something really big. What would be a really big thing, typically, Gary, stuff like, World War II.
Yeah.
Like it's a really big thing. I mean, there was a lot that was incurred prior to that in terms of the social programs that FDR implemented. But then, we kicked in World War II, we borrowed a lot of money, had to get paid back. Kind of the next area, the next kind of big run up that we had was under Reagan with defense spending, just to kind of crush the Soviet Union under the weight of our defense spending, which had a positive outcome. Ended the Cold War. Some might argue we're back in it, but it ended the Cold War. Then, more recently, the debt that's been incurred has been related to a mismatch between what's come in and what's gone out. So what's come in is tax revenue, and it got lowered because we cut rates. So less came in, but then nobody spent any less money. All they really did is they tried to slow the rate of the spending more money than we take in problem. So in other words, like, well, we reduced the deficit by blah blah blah, Gary. It's like, and I mean, you still borrow freaking money. Like, you didn't reduce anything. You just instead of borrowing $100 to fund your deficit this year, you only borrowed 90. Here's your medal.
Yeah.
It's like, my kids are not thanking me for that kind of spending, right now. It's like, I only ran the credit cards up a little bit less than I did last year. So it's like, that's one of the
Yeah.
areas where I do agree with the credit card analogy. That being so that's really where it came from. And if you look at like, you know, what, what really happened, it was, you know, Trump, Trump had the theory that if I cut taxes, that will increase the rate of growth in the economy. Therefore, even though it's sort of like, we'll make it up on volume, Gary. Cut prices, we'll make it up on volume. Which has some grounding in
It
some
can work.
tax. Yeah, it's some grounding in tax theory when you've got really, really high rates. But when it's like when you're just dancing around the rates, like in other words, you're dropping it by that's like going from like top rate of 60% down to 30% like Reagan did, because that's like the last data point where that actually worked. Nowhere else has it actually worked since Reagan. But they're all citing when Reagan cut it. But remember, when Reagan cut it, it's like it was really high to where that's why Reagan stopped working after he made like 2 movies, because he's like, I'm actually working for free because every marginal dollar is going to pay taxes. So he cut that and fixed that problem, and there actually was an economic bump, and there hasn't been one since. Like, I know people like to think that there was, but there actually has not been a bump since. You could sort of say, well, I mean, but what else happened? It's like when Bush did it, and Bush ran up a massive deficit related to the tax cut change, and the counter to that would be, yeah, but 9/11, and then at the end of that, economic meltdown that then Obama inherited into his presidency. And then you can make the argument that, well, did we ever really get a chance to let the Trump tax law changes have any sort of effect, because then we had a pandemic, So it's like, I sympathize with the other side of like, well, it's also hard to say we don't know, all we have is data, but there are also some extenuating circumstances on that data, to truly know if this would ever really work or not. But the other problem that the U.S. has right now that affects us as business owners, related to interest rates, is that, while we may be borrowing a little bit less money than we were yesterday, we're still borrowing money. And the money that we borrowed previously that we're obligated to pay is being refinanced at a higher interest rate. So overall, even if we didn't borrow any more money, the cost of paying that money effectively doubled. So basically, that's sort of like your home mortgage payment just doubled, due to interest rate changes. So it which just further exact, because then you got to continue to borrow money to pay on the borrow money. Like, you see where this doom spiral is going, Gary. Yeah. So
At
it's
some point, the
yeah, it's, at some point,
has to hit.
you can't, the U.S. can't declare the bankruptcy, but at some point we gotta do something to raise some revenue. And generally speaking, most people would say that while increasing taxes would raise revenue, cut the deficit, the other side of that would be you would see some economic slowdown and possibly some job reduction associated with that. Who knows if that would really happen or not, but that's generally why people are loath to do it, because then they're going to be the guys that raise taxes and saw a little GDP growth, fix the debt problem, but otherwise slow down the economy, and some people lost their jobs because of it, but it fixed the debt problem. So they're all painful answers. But anyway, that's just sort of setting the expectation for when you hear stuff out there. That's what's really happening. But in terms of the tax law changes, I'm going to go ahead and share my screen. Can you see my screen, Gary?
Absolutely. Looks pretty good.
All right, cool. I should have put this in PowerPoint so it can be the whole screen. So, but this is in Excel, so you can only see it partially. So what I did is I didn't want to do like a comprehensive, hey, here's every change that you can expect to see. I wanted to hit on like, what's the typical example within the BGW client base of the changes that you're going to hit. And I'll touch briefly on like, well, what happens if you're lower than that, so, generally speaking, so my example is up the top, married filing jointly, about $500,000 adjusted gross income, and I'm a business owner. What can I expect to see? Because if you hear like, if you hear, if you hear the Democrats talk about it, these were handouts to the rich. We got to fix those handouts to the rich. So you start off with, well, what's rich? Rich generally is anybody making over 400 grand. That's the definition of rich. Anybody making, for no other reason than that's the number that they picked. Anybody making over 400 grand. With some, or rich corporations, which are generally those with over $1 billion in sales. That when they're talking about rich, that's what they're talking about as rich. So anything below 400 grand generally isn't touched too much under any proposal, other than just an expiration of the existing tax rates that we're under. So the first thing that you would notice that would be different is that under the Tax Cuts and Jobs Act, the top individual married filing jointly rate is 37%. So like of every dollar that you make over a certain threshold, you're paying it at 37% rate. By way of comparison, under Bush, after he did the tax cut, that went down to 35%. And then under Obama, it went up to 39.6%, which is where it was when Trump inherited it, and then cut it down to 37%. That tax rate expires on December 31st, 2025. So if Congress does nothing, that's what the middle column is. Column C, Gary, is what happens in 2026 when this all expires. So if Congress does nothing, that rate, in addition to all the other tax rate changes that Trump made, because Trump not only changed the top rate, he changed all the rates in the middle to where, if you're on the very bottom end, and I'm talking like real bottom, like 20, 30 grand a year, you saw a little bit of a rate decrease. But if you're above that, pretty much everybody got, a percentage to a percentage and a half rate decrease under the Tax Cuts and Jobs Act. So it did, even though some people only impact the business owners, I mean, other people got some real tax breaks too. So in 2026, all of it goes away. Like every rate reverts back. So the top rate for this guy will be, again, remember, that's not trying to be sexist, Gary. Guy could be, woman is the business owner, man stays at home.
It's a Midwestern term, man.
Yeah,
and we have Midwestern roots. I'll get a pass.
That's right. I appreciate that. They all expire in 2026. Under Biden, the one positive thing under the Biden, again, when I say positive, remember I'm saying that makes it less of an increase, is that what Biden would do is that he would let the top marginal rate go up, just like it would under 2026, but he would actually keep every bracket intact that was in the Tax Cuts and Jobs Act below that. So below 400 grand under Biden, with some of these other provisions, you'll actually get a tax cut. Above 400 grand, you're going to get a tax increase. The second thing that you would see on this same person is that under Medicare, and let me fix my rounding here, Gary. Stand by. Surprised nobody called me on this.
Well, I saw Hayden's on here, so she's probably, come on, Hayden. You should have jumped in on this one.
Yeah, there we go. I'm waiting for well, technically you're inaccurate, Adam. So under, I'm going to hear about that in the text here in about 5 minutes. So technically, under Medicare, once you hit your Social Security limit, whatever it is, $165,000 index for inflation, you still got 3.8% that exists on top of that. That would be the same regardless. Like no matter what happens, that's the same as it sits today. Biden would bump that up to 5%. So that would be a tax increase for this guy. Here's where the fun begins, though, is that with the standard deduction, which again is, hey, that's just the free stuff that the government gives you in terms of just being alive, that comes off the top before calculating your tax. What happened under the Tax Cuts and Jobs Act is that they doubled the standard deduction, but then they took away the ability to deduct your state income tax payments, and also your property tax payments up to a certain threshold. So even though they up the itemized deduction for a lot of people that had high state tax payments, which this guy would, no matter what tax jurisdiction he's in, unless he's in Texas or Washington or Florida, you got it. You basically got a tax increase under this, not a reduction. So what happens both under Biden and 2026 is that reverts back. However, the limit on deducting state and local income taxes expires. So that actually would be a tax decrease if you just think about how most people pay their state income taxes. You can make the argument with the North Carolina pass-through entity tax, which most states also follow the same regime. This is somewhat taken care of, but for those that don't do that, you basically will get to deduct your state income tax payments again. And then the other big one too is they eliminated all other itemized deductions like legal fees, CPA tax prep fees, financial planning fees, unreimbursed business expenses, all that kind of stuff. All that went away too under the Tax Cuts and Jobs Act. That would come back in play under both tax proposals. So technically, if you've got that kind of stuff, that would be a tax decrease. So then you get into, the flow through income that happens on someone's K1. And this is where it starts to get painful under every scenario. Right now, you get a 20% deduction on K1 income. So if my K1 income is 100 grand, I'm only paying as if it was 80 grand. So I'm paying 80 cents on the dollar, makes the top rate for that not be 37%, but instead 28.5% or whatever. So that's awesome. We love that one today. And on December 31st, 2025, that expires. That's bad for most of our clients. That would be a pretty massive tax increase because that right now, 28.5% would go up to 37%, actually 39.6%. So it'd be a little over a 10% tax increase if this is not fixed by the end of 2025. Under Biden, although his latest tax proposal is silent on this particular issue, in the past, he said that he would keep it so he could honor the pledge not to hurt small businesses, which again, he's defined as those that have income below 400 grand. So if you're below 400 grand, this would stay intact. If you're above 400 grand, it'd phase out under his proposal and you'd have a tax increase. So that's the one that we feel like, well, that sucks, generally speaking. This next one sucks too. The net, in other words, like up until this point, I generally haven't been too bothered. Now Adam's starting to get bothered. Yeah. The next one that sucks is the net investment income tax. So if any of you guys have been hit by that, that's if I've got passive today, that's if I have passive income, which generally speaking is going to be, like I've got my, money invested, with our affiliate Destination Wealth, shameless plug, Gary.
I love it. Good job.
Yeah, or any other wealth manager for that matter. And they're doing great, making me hundreds of thousands of dollars, every year on it. There's an additional surtax called the net investment income tax that exists for high income earners that Trump didn't do anything with. Therefore, nothing will happen with it in 2026. The problem with the Biden proposal is that if I own an S corp and an LLC right now, that money is not subject to the net income investment tax, even if I sell the company. So it's not subject on the ordinary earnings that I have every year. And if it's like the place where I worked actively every day and I go to sell it, it's not subject to the net income investment tax either. Unlike if I sold my Apple stock, I'd have to pay this because I'm not working at Apple, right? So under Biden, he would put it on all income. So that's like another, 3-4%, So if you think about like now you're starting to feel some real pain because eliminating QBI brought me up by about 11%. And now we're going to tack another 3%, 4% on top of that. Now I'm up 14, 15% where I was over what I was yesterday, So like that hurts. And when they start talking about reduction in GDP and reduction of jobs, and that's really when you look at the analysis, that's really kind of where it's hitting, is in these flow through company tax rates because you're just going to have less money to be able to pay and hire people, This is another one that could leave a little bit of a bruise. The C corporation rate under the Tax Cuts and Jobs Act is 21%. There's no expiration on that, so they'd actually have to change it to raise it. Under Biden, it would go up to 28%, but there would also be a higher corporate minimum tax that would exist, which would effectively be a tax increase for people that own C corporations. Again, they're really trying to target really large corporations here that don't pay any income tax, but there would be a little bit of a fallback on smaller companies. Next big one is we got a ton of clients that do 1031 exchanges, which is the ability to trade up your real estate without having to recapture any depreciation expense or recognize any capital gain until you finally sell out of all of it at the end. Right now, there's no limit on that. And there's still, since there is no limit and nothing changed on that, there would be no limit in 2026. What Biden would do is he would cap the gain that you can defer to $500,000. So again, his argument is, well, we're not going to let, the wealthy real estate investors not pay tax because it really, you can, on the one hand, you could say, hey, Gary, because I was able to defer the gain, I was able to, put more money into building that new building, which created more construction jobs. Totally get that. That being said, if I'm savvy about this, I could actually never pay taxes because I buy something, I sell it, I don't pay taxes, I roll it into something new, and then I borrow some money to get my equity out, and then I buy something new, I roll it over, I borrow some more money to get some more equity out. So I'm getting my cash, but I'm not effectively paying taxes. So like at some point, this is one of those things where it's like, the real estate investor is going to say, well, eventually I'm going to have to pay the tax, but like when? Like I could do this for 50, 60 years. I could die. My kids could inherit it, and then they get a step up in basis. This tax is avoided altogether. So it is one where it's like, it's a hard one, in terms of what's the right answer. Should you be able to be in a scenario where you never have to pay tax? I don't know. It's a hard one to figure out. But it kind of goes back to my Duke Energy example, God bless him. But they have a massive benefit from the equipment that they put in service to produce solar power, and then they get a massive credit for producing that same power. Thus, if they just said, hey, let's double our income every year, it would take them 50 years to make money before they'd have to pay any taxes based on the stored up deferred tax assets that they have right now. So like that just seems like, I get it. Oh, well, eventually we're gonna have to pay those taxes. Like, when my kids are dead? You know, so like at some point, shouldn't somebody have to pay something? I don't know. Anyway, bonus depreciation under the Tax Cuts and Jobs Act, that was going away regardless, to eventually be phased out to zero. People, the big difference between bonus depreciation and Section 179, because people tend to use those interchangeably. With Section 179, if you make money, you can expense property immediately that you buy. So it's 100%. And the only limitation is based on the amount of property that you place in service or the income that you make. And that's still pretty freaking high. With bonus depreciation, you know, such limitations don't apply. And the neat thing about it is that I don't have to have income to use it. So I could have a massive loss in one company, income in another company, and get the two to somewhat wash each other out. Whereas I can't do that with Section 179. So it had, even though they seem like they feel the same, there are some differences between the two. Those were set to go away anyway. And the Biden, you know, under Biden, that he's silent on if he would do anything about that. So I guess I put tax increase. I mean, technically it was going to increase anyway, so hard to pin that one on Biden because that was going to increase anyway unless they did something with it. Interestingly, this was one of the areas where the House said, "Hey, let's go ahead and extend bonus depreciation for people, and fix at least that element." Went over to the Senate. Senate doesn't have a problem with that. Senate has a problem with the child tax credit. So that's why the whole tax law change that Congress passed that would be more favorable to business owners is stalled and looks like there's potential that it's going to go nowhere. I think Randall had a question on the tax on unrealized gains.
Yeah.
So you have where that would show up in two places under buy. I didn't put this on here, but you have where that would show up in two places on here. One would be, you know, just I've got over a certain level, you know, I pay taxes on unrealized gains, meaning like Gary's worth, you know, this would be a nice problem to have, Gary. Gary's worth 100 million. His portfolio goes up by 10%. Now he's worth 110 million. He has to pay taxes on the $10 million in gains, even if he didn't actually sell anything. Because right now you don't have to pay taxes on the appreciation of assets. That's one place that they're talking that it would hit. And again, that would be targeted at really, you know, what they would consider the top 1% of people. The second place they've talked about doing it is that upon death, what can happen is like same sort of scenario. You know, Gary's worth $100 million, but Gary's cost basis is $20 million. So there's $80 million of gains that are built up in that. Those gains roll to this bad example because I'm above the estate tax limitation, but pretend that I'm not. Those gains roll to Gary's kids, and their new basis in the stock is now 100 million, which is what it was worth at Gary's date of death. Thus, no capital gains were ever paid on it. You know, Gary's heirs would argue, well, Gary paid taxes before he bought it. Wasn't that enough? The government would take the position that, well, you kind of could hang on to it forever and never pay taxes if you never sold it. So the other place they're talking about doing it is upon death, as an additional element of the estate tax, having some form of tax on unrealized transferred gains, which ironically would then make you have to probably sell stuff off, to pay the tax, which would then you see where that turns into a shit
Yeah.
show.
Yeah.
So I think on that one, Randall, it's hard enough to track cost basis now, that I I feel like of everything that they proposed, that one probably has like I could see, depending on who has Congress, I could see column C, which is the 2026, or the column D, like some version of that happening. Even under a Republican, House, even if everything were status quo, I could see some version of C and D happening. The tax on the unrealized gains, I think just the level of the pain associated with actually figuring out how you're actually going to track and report that would cause enough lobbyists to come out and say no, for now. So I could see that one. That's the one that I feel like the least likelihood that dog's going to hunt, because even within Democrats, you really, like, I don't even hear Bernie Sanders talking about that. It really has been Elizabeth Warren, so like I just don't see that. I don't see that hunting as much, because then like now all of a sudden every member of Congress, because what happens when you go to Congress, Gary? What happens when you go to Congress
You
is
make
suddenly,
150,000 and all of a sudden
yeah,
become millionaires.
yeah, exactly. And it doesn't matter which party you're in. Somehow it magically
Exactly right.
happens. Guess what? They would all be hit by this, because most of the way that they make that is shockingly through their investment portfolios, of which they've never done any insider trading, because there's a rule against
Oh,
that. That's somewhat self-reported. So,
right.
so basically, most every Congress member that's had an increase in their net worth has generally been liquid and investable assets. Like they just magically, somehow, mysteriously came into some money to buy some stocks, right? So they'd all get hit by this, and I mean, like, I just don't see a scenario where, they get super excited about writing checks, for this. So anyway,
They'll write checks that you and I fund, but not that they have to fund.
yeah, that's right. That's right. Yeah. So that's the general theme of what we see happen. And again, the reason I wanted to share this week is that, especially as the campaign trail gets heated up. I mean, I don't care who anybody votes for. As Gary will attest to, my hot button issue is when people just misrepresent information. And when people talk about, like, tax cuts were going to the super wealthy. Well, not really. Like
Right.
I get that you could consider $500,000, super wealthy by some standards. You talk to that person that makes that as a business owner, they don't feel super wealthy, you know,
No.
especially with like today's house prices and everything else, and the cost of college and everything else that goes along with it. And then on the flip side, you know, the Democrats are going to tax us into oblivion. It's like, okay, above 400, worst case scenario, maybe 10 to 15%, which is a lot, but that's not oblivion. You know, that wouldn't be an incentive to vote one way or the other. It just meant to simply say, it's not great, but it's not all bad.
I think it's ironic though that you know, back in 1776 they revolted and they went and risked their lives on a 3%.
Yeah, I
Like
know. Yeah.
think
Yeah.
about that.
Yeah, I know. I know. How
These
dare
guys
you?
went
Yeah.
in arms for
Yeah.
3%.
Yeah, income tax itself is just something that we created out of it. I mean, we weren't the first to create it. It's just something that we we finally implemented as a country, I believe, in the first part of the 1900s. So whatever it is, the amendment that's called the Income Tax Act. So, so there you go.
So wouldn't it be nice if we had a 50-year jubilee that would just wipe out all the debts? If we would go back to that system where, I mean, what a wonderful thing. Because I don't know, how in the world are you going to wipe out the mind-boggling trillions of dollars of debt that we've amassed? I mean, it's like, yeah, well, we're spending less than last year. So to your point, give us a medal. Wait a minute. It does make you wonder. I don't know. It's too lofty for me, but it's like, man.
I mean, again, you go back to why it's such a painful problem. I could probably find a pie. Well, if Jack were here, this would be the perfect opportunity
Yes.
for him to bring up the pie chart while I'm stalling for time. Since he's not here, we're not bringing up the pie chart. So this is off the top of my head. But generally speaking, if you look at the big four categories of where the U.S. government's money goes, one of them, a big bucket is Social Security, Medicare, Medicaid, which some would say, well, let's just reduce that, Gary. The problem with that is that you're collecting money from Gary to pay for it. So I collect tax for Social Security and then I pay out tax for Social Security. And that difference isn't that great. So if you said, well, let's just cut Social Security benefits or Medicare and Medicaid benefits, I mean, you're going to have riots in the street saying, well, then you better cut my taxes, because I paid for that crap. So that's a hard one. The next category is defense, well, we shouldn't be the world's policeman. Well, a lot of the defense spending is actually personnel benefits. So what, we're not going to take care of the troops, Gary. And then the next big category is the debt itself. What, are we not going to pay it? So you're sort of left with I guess we're gonna have to suck it up and save more to pay down our debt.
Right.
So because if you think about it, it's like, well, actually, I'm still sharing my screen, right?
Yeah.
So what I am gonna Google this right now. What is
I
the
did a Google and it brought me up all kinds of pie charts that were irrelevant because of like 2019 or students. I'm like, no, I said US federal government spending and budget. But so anyway, my Googling skills are not as expert as Jack's, but I'm not a lawyer either. So in the meantime, Matt says, remember, most of the founding fathers were beneficiaries of total loan forgiveness by declaring independence from Britain. They wiped out the debt to the crown. Oh, good point. Yeah, and they definitely risked their lives and everything because hung for treason if they didn't win. So, speaking of this, so here's another little trivia thing. So I was talking with a guy this morning at a breakfast, and he said, isn't it amazing? He had seen George Washington's wooden teeth in Mount Vernon. Like, okay, think about that, because we were talking about kind of modern advancements with some of the crazy stuff I had done with my eye surgery 2 weeks ago, and he said, Washington actually died from the flu. But it wasn't the flu that killed him. They did bloodletting, and he died because he didn't have enough blood in his body. Like, isn't that crazy? He survived, Valley Forge, but the flu took him out because the modern medicine thought, taking all your blood out was the way to go. So anyway, that's just interesting. So thanks for the tip there, Matt.
Yeah,
And then
I got it.
Skip said, just jumped on, may have missed the conversation. How about the sunsetting clause coming at the end of next year with the estate minimum tax limitation being cut down? So we have already covered that. Skip, you have to listen to the recording later on today. We'll put it up on the BGW CPA YouTube channel.
Yeah. So the calculation I did here is 33 trillion. That's our current national debt. 330 million people. Every man, woman, and child in America now has responsibility for 100 grand in debt. Is where we're currently sitting. Just to put that in context.
Oh, and that'll be great for the people, the babies,
Yeah, yeah.
kids in elementary school and
Yeah,
people
just
on
so
food stamps.
yeah, just so we know where we're at. Not that it's all doom and gloom, but yeah, to Skip's point, the state tax we hit it in terms of the context of the unrealized gains tax, but the state tax limitation also does roll back in 2026 by 50%. We just didn't hit it on this because that Biden would keep it at the rollback levels with some other tweaks around it as well. But we're really trying to focus on like what's the hit for like Joe average business owner versus like every change that's been made.
Yeah.
So yeah, that's what the doom and gloom. When people talk about doom and gloom, that's that's what we need to be in for. And I think what I would go back to saying is that you hear people get hung up about like, well, that's it, tax is too high, I'm just not going to make any money, Gary. you know that really is like taking poison and hoping that the other guy will die. So I do hope that people, because I think the business owners that I like the most are the ones, like the old timers. When you hear like, made money under Ford, made money under Carter, made money under Reagan, made money under Clinton. Like either way, I figured out how to make money, and taxes was just a cost of doing business.
Yeah.
And sometimes I paid more of them, sometimes I paid less of them, but they didn't let a tax rate stop them from being successful. And in fact, I can't, I read this somewhere, but in a higher tax rate environment, that's actually when some of the most entrepreneurial companies on the planet have been started. So that's not like saying, you know what, Gary, we need some more innovation. I know what we should do. Let's
Puts everybody in
right. Let's
oblivion.
let's raise. In other words, like that's sort of like one of those 100% of people that eat carrots will die, Gary. They will. So if you don't eat carrots, you will not die. That's not saying that higher taxes create entrepreneurial companies, but it is saying that it's not, it is also not the end of the world if that's the thing that happens, even though it will suck ass. Like, have you ever counted your calories, Gary?
Oh yeah, I've done My Fitness Pal, man, and that's laborious.
Yeah, so when you're like, hey, I'm gonna be cutting and I need to be on a 1,200 calorie diet, how much did you enjoy that?
0%.
Yeah, it's sort of like colonoscopy prep too, right? Like that's not enjoyable either. Yet I lost 8 pounds.
Right.
So kind of look at but I didn't die. That's how I kind of look at this.
Yeah. Yeah, I think you're right. I mean, mindset really does matter. I remember talking to a guy that launched his business right as like in I think August of 2008. Well, September 15, if I remember right, was the big 700-point drop or whatever when the Dow was far lower than what it is now. And he said that, and it was a retail business, and so it was like, man, everything was bad. And he's like, I just could not listen to the news at all. I just had to focus and hunker down. And he grew a really great business in a really crappy time. And we've seen the same thing with COVID, which launched this whole this crazy train of the webinar. It still comes down to mindset. Control what you can control, which are only two things. Thank you, Coach Nupp. Two things: your mindset, your attitude, and your effort. That's it. And so if you want to throttle back your effort so that the man, Uncle Sam, doesn't take so much, so be it. But, like, hey. So anyway, Matt has added a couple tidbits here that are interesting. One is, he says young people in their 20s and 30s, especially those with children, need help with rising education costs, rents, and food costs, as wages are not rising fast enough. This predicts greater unionization success. And then another tidbit: Washington suggested he could not in good conscience take a salary. Alexander Hamilton, Jefferson, and Congress replied, having had the good fortune to pay the general's expenses, they would prefer to pay him a salary. So another good tidbit about Washington today. Who would have known that we would have gone down that rabbit trail? But interesting stuff. I'm glad that we are not using and relegated to wooden teeth. That's a beautiful thing.
That's right.
It's a beautiful thing. And yeah, I mean, there are plenty of things that we need fixing. Like our healthcare is a mess. I still like, even though I pay out of pocket and I still have health insurance, I like my naturopath that I have to pay 100% out of pocket because I have better care. And by the way, when you have to go to the doctor for certain things, it's a whole lot less money. Like, it's crazy.
Yeah, no, I know. But I mean, that kind of gets back to, the making some decisions. I mean, you know, this is directionally correct, but like Taiwan spends, I want to say 20% of what we spend on healthcare, yet has better outcomes than we have.
Yeah.
Like,
And
that's
outcomes
crazy.
are the thing.
Right.
I mean, that's it.
Yeah, that's crazy. The other thing I did want to hit on too, Gary, if anybody has any questions before we wrap up here, is that,
Yeah.
there was, we didn't talk about it on this, but just a heads up, I think it should be our topic for next week. Two big changes on employment law that happened, that, unless they get overturned by court, looks like they're probably going to happen, is that, one is the Department of Labor is phasing in the requirement to pay overtime to salaried employees, which, like, all this sort of thing. Oh, I got somebody on salary, I'll treat them as exempt, from all this, and, they'll just work as much as they need to work. So if you think about like BGW, that would be the, not that we, well, I mean, I guess we can't do this. That's the typical staff that just graduated from college. Well, before the change in the amount, they worked overtime, but we didn't have to pay them overtime because their annual salary was higher than the limit that would have required us to calculate overtime. Because it's off the top of my head, but it's like 30 some odd $1,000 was the minimum salary level before you had to factor in overtime. I think that's bumping up to like $56,000. So suddenly it starts to get into the strike zone of what a lot of people pay people. That was number one. And then, sort of like, people say to me, well, if they go to a flat tax, you'll be out of work. Jack, if they get rid of non-competes, you'll be out of work. They also basically were outlying non-compete agreements. So I think next week will be Jack's time to shine.
Oh boy. Well, and he'll have all kinds of stuff. He'll be coming loaded for bear. Plus, he'll be completely rejuvenated from all those, endless meetings in the boondoggle place of wherever he's at. So, not that attorneys do that. I just
Right.
read a book about it. So anyway, we will be glad to have you back, Jack, in case you're listening to this. thank you everybody for joining us. This has been another good one. We'll end about 10 minutes early unless somebody else has stuff that you want to stump the two chumps remaining here. That's fine. If you got something else that you want to hit us up, because we're here and we're not charging you. So anyway, but if anybody was late, we will put this up on the BGW CPA YouTube channel later on today. And if you guys have any other thoughts for future topics that are on your mind, let us know. We want to bring relevant stuff to you. So thank you, Robert Mayetta. It's so good to see you on here, as you always are. We appreciate you tremendously. And I hope you guys have a great rest of the week. Enjoy this beautiful weather, man. This is the time to be living in Charlotte, North Carolina. I'm telling you, what a beautiful day. Thank you,
Awesome.
Adam. Good
All right,
job.
thank you, Gary.
See ya. All right, bye-bye.
Bye.